The hidden truth behind market unpredictability. Markets are like living, breathing organisms. They pulse with life, move in complex patterns, and at times erupt with unexpected energy. They often appear predictable until they aren't, shifting unpredictably and catching even the savviest investors off guard. But what if this unpredictability, rather than being an abnormality, is actually an intrinsic characteristic of the markets? In this video, we'll explore the forces that create market unpredictability, the lessons we can extract from past events, and how embracing this uncertainty can lead to smarter investment decisions. By the end, you'll see that understanding unpredictability isn't just helpful. It's essential to thriving in the ever-changing world of investing. What makes markets so seemingly erratic? To unpack this, we first need to recognize that the driving forces of markets are far from straightforward. Markets are influenced by a chaotic mix of factors, from global economic policies to the emotions of individual investors. First, let's examine the obvious: economics. Macro and microeconomic trends play a significant role in influencing markets. Interest rates, inflation, unemployment data, these figures set the stage for market behavior. Next is the unpredictable impact of geopolitics. Wars, trade tensions, and political instability can send ripples or tidal waves through the financial world. For instance, a speech from a global leader can send markets spiraling upward or downward in a matter of minutes. But markets are not just governed by logical external factors. They also operate on emotions and psychology. Human behavior driven by fear, greed, optimism, or skepticism can lead to major price swings. Herd mentality frequently causes large groups of investors to either pile into or flee from certain assets, often exacerbating turbulence. Then there's technology. Algorithmic trading and AI-powered tools have made markets faster, but not necessarily more predictable. These programs make decisions in nanoseconds, but even they cannot fully account for emotional and external shocks. This combination of logic, emotions, and external influences ensures that unpredictability remains inherent to the markets. To further understand this phenomenon, we'll look at two key examples of unpredictability: the 2008 financial crisis and the COVID-19 pandemic. The 2008 crisis demonstrated how seemingly unrelated factors can converge into financial catastrophe. Leading up to the crash, rising home prices fueled confidence in the U.S. housing market, and financial institutions created complex derivatives based on mortgage loans. But when defaults started to rise, fear spread and markets rapidly unraveled. Despite a range of models and forecasts in place, no one saw the full extent of the meltdown coming. The interconnected nature of the global financial system magnified the crisis. One domino fell, and the rest followed. Fast forward to 2020, when the COVID-19 pandemic brought a different kind of unpredictability. As the virus spread globally, panic set in. Markets tanked initially, reflecting fear of an unprecedented economic shutdown. Yet, surprisingly, they rebounded in record time as government stimulus programs kicked in and investor optimism surged. Both of these examples highlight the same lesson. Market models and predictions have their limits. Factors like mass panic, government intervention, and unexpected global events can render even the most well-reasoned forecasts useless. Here's the good news: unpredictability isn't all bad. In fact, it can be a source of opportunity for prepared investors. When you acknowledge that volatility is a built-in feature of markets, you can develop strategies to not only protect yourself, but also potentially profit. Unpredictability creates scenarios where undervalued assets can emerge. Sudden sell-offs are often driven by fear rather than logic, presenting moments where disciplined investors can find bargains. For example, during the initial 2020 COVID-19 sell-off, some long-term investors bought high-quality stocks at significant discounts, ultimately generating sizable returns as markets recovered. The key lies in maintaining a steady mindset. Reacting emotionally, either by panic selling or exuberantly buying, often leads to missed opportunities and poor outcomes. By staying calm and focused, you can view unpredictable times as opportunities to strengthen your portfolio rather than threats. If unpredictability is here to stay, the next logical step is to learn how to navigate it. Fortunately, practical strategies exist that can help you deal with volatile markets. The first step is a mindset shift. Understand that markets will always have elements of unpredictability, no matter how advanced forecasting tools become. Investors who accept this reality are less likely to overreact to sudden changes. One of the biggest mistakes investors make is attempting to predict market highs or lows. This strategy, known as market timing, is incredibly risky and rarely successful. Even seasoned professionals often fail at it. Rather than trying to anticipate exact movements, focus on long-term growth and consistency. Diversification is a cornerstone of any sound investment strategy. By spreading your investments across different asset classes, stocks, bonds, real estate, and perhaps even alternative assets like commodities, you can mitigate risk. When one asset class suffers, others may hold steady or even perform well, balancing your overall portfolio. Markets may appear chaotic in the short term, but over the long haul, they tend to trend upward. By adopting a long-term investment perspective, you can ride out short-term turbulence and capture broader market gains. Instead of investing large sums all at once, consider dollar-cost averaging. This approach involves spreading your investments over regular intervals, regardless of market conditions. Doing so reduces the risk of buying in at high valuations and smoothens out your average purchase price. Having an emergency fund is especially important in volatile markets. This safety net ensures that you won't be forced to sell investments at a loss during periods of instability to cover unforeseen expenses. Markets are unpredictable, and so is your emotional reaction to swings. Use periods of volatility to reassess your personal risk tolerance. Align your investment strategy to what feels sustainable for you, mentally and financially. To navigate unpredictable markets effectively, you need a framework guided by principles, not guesses. Remember why you're investing in the first place. Whether it's saving for retirement, funding education, or buying a house, staying focused on your long-term goals can prevent errors caused by short-term emotion. Sometimes, strategic portfolio adjustments are necessary. For example, increasing your allocation to bonds during turbulent periods may decrease overall volatility. If uncertainty is overwhelming, don't hesitate to work with financial advisors. They can provide objective, data-driven recommendations tailored to your situation. While metrics like price-to-earnings ratios and market valuations are helpful, they are only pieces of a much larger puzzle. Use them as guides, not guarantees. At the heart of navigating market unpredictability is adopting the right mindset. The search for perfect certainty in investing is futile. Instead, focus on the things you can control: your reactions, your strategy, and your goals. Give up the notion that perfect investments exist. Every strategy carries risks, and no one, not even experts, can truly predict the future. What you can do is stay grounded, stay informed, and stay disciplined. Understand that unpredictability is not the enemy. It's part of the natural evolution of markets. In fact, markets that are too stable often fail to deliver sufficient returns. Embrace the reality that uncertainty is simply a feature of investing, and use your knowledge to steer through it with confidence. To recap, market unpredictability isn't a flaw. It's an inherent part of how financial systems operate. While outside forces like the economy and geopolitics influence markets, so do internal factors like human behavior and algorithms. History has shown us that even the best predictive models have limits. The good news is that by accepting unpredictability and adjusting our strategies, we can thrive in its presence. Focus on diversification, long-term thinking, and maintaining a calm, disciplined approach during turbulent times. The hidden truth behind market unpredictability is simple. No one can fully control it. But with the right mindset and tools, everyone can prepare for it. Embrace uncertainty, turn chaos into opportunity, and build a brighter financial future for yourself. Thank you for watching, and remember, the best investor is not the one who predicts the future, but the one who prepares for it.